This is Kay Lee speaking for the lazy trader on which particular trading system you should trust. This is quite an important topic, particularly for newbies, even for people who have been in the markets for 2 or 3 years, and they're still looking for that system, that elusive system which will produce the profits that they desire. It's a bigger question than most people realize, because sometimes, especially lately, the focus has come onto the reward for risk in the market. And whilst this is quite important, the question of how you analyze the market, how you build strategies into a system is a very important question. It's the basis of the entire business model which a trader builds the trading regime on, as it were. So without further ado, let's just get into it. This is the disclaimer, and we'll begin with the question of who or what do you trust? Clearly, there are many things that a trader could rely on in the markets, and there is no shortage of information that's available. The question that one has to face is the one of how do you process all this information, what do you rely on, and what do you do when they disagree with each other? There must be a starting point. Clearly, if a trader starts randomly, so if you believe a tip today and then you look at something in the news tomorrow and then maybe look at the charts the day after and then get some advice from a financial advisor 3 or 4 days down the road, and in the next week you get some tips from friends, all this adds up to an incredibly unsystematic approach, and this sort of tactic will not lead to consistent profitability within the markets. There are personality types which thrive on overanalysis, and this leads obviously to analysis paralysis. The idea that you need to incorporate all that information into your trading decision can be helpful, and it might not be helpful. For very many people, I would suggest that it isn't helpful. In fact, it would be far better off if you focused on a few things and learned how they fit together, learned how they interacted with each other, and what to do when they disagree. That's a far more useful approach, in my opinion. So there are obviously also sand traps. The tips and friends in particular tend to be a non-profitable strategy for most traders. The key thing, and perhaps the beginning point for the journey for the ideal trading system, it doesn't exist, but one can get close, is to ask yourself, what do you believe in? What really makes sense to you? Given the way that everyone is different, someone might have it in his psychology to believe more in fundamentals, more in the basic economic sense of the markets. And that's certainly a valid approach. What it does mean is that it's usually going to lead to longer term investing, because an economic opinion very rarely produces results within 24 hours. For most people looking to profit from shorter term swings to the market, it becomes necessary to look at the raw data. Now, this data might come in the form of news announcements, and this is certainly useful to some sorts of trading. For most people, what it means is they will be looking at the charts. They will be looking at what the history of price has been doing, and hopefully that will give them some indication of things to come. There are quite a few academic controversies about whether one can do this, and it comes down to this question, what do you really believe in? There are many studies that do prove that technical analysis works. There are just as many studies that claim that they don't. So at this stage, it's a 50-50 proof on the intellectual side. So it comes down to, firstly, the personal beliefs of the trader, and then the proof is in the pudding, as it were. Will the trader actually be able to produce profits in his account? So before we go much further, it is useful to review the fundamental tenets of all technical analysis. And this comes down to three key ideas. The first one is that price action discounts all views and knowledge. This is an absolutely key idea because we accept that information is not perfect across the market. Some people know more, some people know less, some people analyze better, some people analyze less well. What happens is that all the bets, all the speculation, as it were, is reflected within price. And price reflects even more than that. It reflects the actual economic activity. For example, if you're trading Forex, you are not trading just against other speculators. In fact, the ratio of speculation to actual economic activity is very, very low. Most of the factors which move the Forex markets are fundamental factors, are businesses moving actual cash across borders, changing different currencies in order to pay off debts in different countries, their central banks and their transactions. All this comes down, it's a lot of information, and one of the fundamental tenets of technical analysis is that it's all reflected in the history of price. And furthermore, that history repeats itself in repeatable patterns, in patterns that can be anticipated. Please note that I do not say predicted. It's practically impossible to predict the future. However, it is possible to anticipate it. It's quite an important distinction. Now, the most important practical aspect of technical analysis is that because we're basing it on data and patterns of data, if we're wrong about the markets, we are able to set a point at which we can safely say, well, the analysis went wrong, something went wrong somewhere, something just didn't work out. And when that happens, we take the loss relatively quickly. So it may well be that a technical analyst is wrong even more than 50% of the time in the market and still be profitable. It's not about the prediction. It's about getting out quickly when you're wrong, and when you're right, riding the trend all the way to the end, or certainly as far as you can make it. So, with that in mind, the question that comes up is there any benefit to trend trading? Is there any benefit to technical analysis? What seems to be the case is that prices are not random. They do have what we call katotic returns. The returns, the movements in price are surprisingly trendy. They go in one direction for longer than most people would anticipate. So this is what John Maynard Keynes would have meant when he said the market can remain irrational for far longer than you can remain liquid. So when we look at the markets, it makes far more sense to bet that a trend can extend much longer than someone anticipates. Therefore, in the long run, it makes sense to ride that trend. At this stage, newbies or even fairly experienced traders can try to get cute. There is a fairly popular idea that's been floating around for quite a while that one should be a techno-fundamentalist. There are certainly perils to this approach. A techno-fundamentalist is someone who looks at the technicals, who looks at the charts, but also looks at the fundamentals of a situation. This is particularly prominent, popular amongst stock traders, where they believe if I can get a good company and then trade it using technicals for timing, then I should get a better return. And some people do this. It is arguably possible that someone would be able to achieve superior returns doing this. However, for most people, it can be perilous, to say the least. One of the reasons why this is so is that very often being a fundamentalist or analyzing the fundamentals relies on you identifying a price action or a price motion that has not occurred. An example would be if a stock crashed or even a currency crashing. And then you're looking at good core earnings, good industry growth, good opportunities, and saying, well, in that case, eventually the market should return to a higher price level, and it makes sense purchasing that stock or collecting it while it's cheap. The problem with this is that technically there is usually no basis for doing this. There are aspects of technical analysis which do rely upon the end of trend predictions, and they can be profitable, certainly. However, for the most part, most technical analysis systems rely on you identifying a trend or identifying momentum in the market and then trading in the direction of that momentum. Well, then you have a paradox, because the market might be coming down and the fundamentals might be screaming at you to buy, and the technicals will be screaming at you to sell. This kind of dissonance between opinions is a source of great confusion amongst traders. And in spite of what one thinks, it is quite amazing that most traders do not actually have the patience to wait until the market has actually bottomed out, until the trend on a fundamentally good company starts picking up again, because this could be 2 or 3 years. The number of traders that I have seen over the years just blow up their accounts because of this. They'll just wait until the market is beginning to do that last crash, and they'll think, well, it can't get much worse. I'm going to buy in now and start collecting early before the technicals kick in, and guess what? It gets much worse. So this sort of multiple viewpoint system is good if you're an expert level trader, if you're someone who knows what he's doing. However, for most people trying to be cute about trading, this is a very dangerous path to be starting on. Certainly to learn both the skill sets of technicals and the fundamentalists, as it's a lot of information to digest, to say the least. So as we look at the goals and philosophies of each approach, we realize that all of these approaches have different tactics for expressing themselves. Even the banks, which use algorithms, which use different sorts of arbitrage systems, all of these things rely on different concepts. And these concepts and philosophies may not be in line with each other. For example, news trading would be very much against value sometimes. On the other hand, news and momentum are potentially systems that could be integrated into each other, because, for example, one could anticipate a certain reaction to the news, and once the news announcement was made and momentum confirmed it in a certain direction, one could potentially try and hop onto a move if you had good enough prices. There are all sorts of issues that come up with this. However, since the question that we're discussing today is which system you trust, what I would suggest the beginning trader does, or even the searching trader on that part of the looking for the holy grail, as it were, in their journey, I would suggest that the best thing to do would be to read up generally on the philosophies behind each approach, the tactics behind each approach, and when you get an idea of what each is trying to achieve, you will be in a much better position to decide what's right for you. So, if you end up, obviously, as we've already discussed, if we end up having contradictory systems, then the entries and exits in particular will cause a lot of disruption. When one system screams buy, the other system screams sell. Even within disciplines, this is possible. And I'll give you an example of this. There are technical traders who trade ranges, and there are technical traders who trade trends. So if price breaks out of a range, the trend traders will very likely say, well, this is the beginning of a new movement up or down, depending on the direction of the breakout. Whereas there will be just as many, or a certain other chunk of the market which looks at it and says that's probably a false breakout. It will probably return to moving sideways, because price does move sideways a good chunk of the time, probably 60 to 70% of the time, and therefore they will go counter to the breakout. These contradictions cause a lot of problems, and one is well advised to understand what the system he's trading is trying to achieve. More experienced traders will integrate trend, counter-trend, and breakout systems into their overall strategies, and this is certainly a valid way to approach the market as well. So when we look at these various things, it becomes obvious that it's impossible to master all these strategies overnight, and it would be far better if the trader picked up one system, mastered it, understood its weaknesses, and tried to hone his understanding to the point where he's able to make it profitable. This does take a longer time than most people anticipate, and so ultimately there is no shortcut, because we're saying that the key to success is in you. It is up to you to do the back testing. It is up to you to do the forward testing. You have to make the system that you're exploring convince you that it is a good idea. Someone else might do the back testing for you. Someone else might have done the forward testing. That's not good enough, because chances are good that when you take that system and implement it into your trading regime, you will find nuances that the original creator of the system understood, having done all the back testing and forward testing himself, but you don't. What do you do when this happens, when that thing turns in this way? What happens if you enter a trade and it goes slightly profitable and then turns around and heads for your stop loss? What are the appropriate actions in the context of the system that you're trading? All this will weigh on your trading results if you have not done the homework. It is, of course, acceptable to buy a system that has good back-tested results. However, it still doesn't excuse you from at least taking the thing, looking at history, and saying, how well has this done? If I were implementing the system, how well would I have done? And how does this fit into my lifestyle? The lifestyle thing is incredibly important, because some systems rely on intraday trading. Obviously, within the context of lazy trading, you don't want to spend very much time. Even then, there is a cost, because you have to monitor the markets regularly and consistently. I tend to favor intraday trading or shorter term trades myself. It does not matter if I miss a few trades, because the market evolves and gives far more opportunities. Even then, I have to be careful not to miss peak season. This happened, for example, December 2015 and January 2016 was some of the most profitable times in trading that I've seen in quite a long while. And if I had been on holiday during that period, I would have missed it. So there are pros and cons to each approach, and you have to convince yourself, and not just convince yourself, but figure out whether it will work for your particular situation. There are issues on all aspects, all right across the spectrum. There are people who, for example, do not have enough capital to hold an investment for a year, 5 years, 10 years, in which case they're going to be ending up doing relatively shorter term trading. On the other hand, there are people who are going to be too busy to do intraday or even end-of-day trading, and they might decide to go with a strategy that gives them lower returns but doesn't require them to adjust their portfolios that often. All that is, it comes down to the individual trader's situation, and that's where the legwork is. Obviously, once you have done the legwork, then it becomes playing the game. Once you have convinced yourself that the system does work for your situation, then you join the game, you put in good money, or you put in some money and you increase the chunk as you gain confidence over time, and you don't lose focus. You keep calm and you keep carrying on. What happens in many cases is that the first time a good, even high probability system runs into 6 or 7 losses in a row, the trader loses confidence. Well, where are your backtest results? Where are your forward testing results? What was the maximum number of consecutive losses for the system historically? Is this normal, or is this a new run of consecutive losses? Should you be worried? All these things should have been decided right back there in the preparation stage, on that stage where you have all the numbers, and like anything else, like any business, there is risk involved, but you should have defined that risk before you actually put good money into the markets. So once you have that, then it's a question of adapting. I do not mean that once you tie yourself to the mast, once you start trading a system, you never evolve, because markets do evolve. Markets change all the time. What one has to do is to look at what's working for the system right now, and then to look at what's not working for the system, and then asking, well, can I change something, or can I adapt to the situation in a way that does not impact the trades that are already profitable? This becomes the mark of the trader who will survive. Adapting does not mean changing willy-nilly, because if you change without further testing, the chances are excellent that you will lose the trading edge of the system in trying to change too much. There are many traders who start out with a written trading plan and then end up looking back at the way they trade and are horrified to discover that they're not trading in any way, shape or form in accordance with the rules of their trading plan. If this happens, then you know that you've deviated too far from the system. So in any case, I hope that gives you some idea as to how to start looking for the appropriate system for yourself, and I wish you all the best in your trading.